Welcome to PhillipCapital Weekly Market Watch. I'm Chung, investment analyst from Phillip Futures. The latest run-up in grain prices come at a time when the world economy is slowing, the Eurozone is in turmoil, and unemployment is higher almost everywhere. The danger for poor countries is that their fiscal firepower was eroded by the global financial crisis, and their ability to deal with bigger food import bills will be limited. The UN Food and Agriculture Organization Food Index jumped 6% in July to hit a figure that is higher than in 2008. And the Food and Agriculture Organization warned against the kind of export bans, tariff, and buying binges that had worsened the price surge 4 years ago. We believe that this is a supply shock, prices will spike, and if the next harvest is more back to trend or back to normal, food prices will come down. Still, there is a temporary reduction in real incomes, especially in emerging and developing economies. This is not helpful to the extent that the global economy is carried by emerging economies, and higher food prices will feed into domestic food prices even if it is a limited pass-through. On the upside, concerns over inflationary pressures are less than they were in 2007, and high world oil prices have eased. Besides, exchange rate movement also have a role to play. The depreciation of the US dollar against many currencies blunted the impact of an increase in the dollar price of food at the time. In many developing countries, local food prices are usually lower than international prices, and consumers can rely on domestically grown food. The world is better prepared for food price spikes due to lessons from the 2007 crisis that led to more investment in farming and a push for more transparent agriculture data so countries can better anticipate and manage price shocks. In conclusion, there are fewer concerns now about underlying inflation given current global economic conditions. Therefore, if it is a classical supply shock, it will feed into headline inflation to some extent, but is less likely to feed into underlying inflation. In that sense, it should be less of a monetary policy concern. Thank you, and stay tuned on more Market Watch videos.